Hello, everybody, and welcome to Real Impact Tracker's webinar introducing the certified Real Impact community. My name is Gabe Rissman, and I'm a co-founder of Real Impact Tracker. I just want to take care of a little bit of housekeeping before we start the webinar. For those viewing on the computer, we will not be using the chat or raise hand feature, but you may ask questions using the Q&A feature, which is a button you should see on the top left of your screen. You can ask these questions and I will be going through and answering during the webinar. And any questions directed at the panelists, I will collect and ask to the panelists in our Q&A session at the end. If you are joining via the computer or phone, you are able to follow along on our website, which should be linked in the chat, www.realimpacttracker.com. That's where you can see more information about our methodology. And as the community members speak, you can follow along with their community pages. Finally, I just want to provide a quick disclaimer that Real Impact Tracker is not an investment advisor. We do not offer financial advice. The information we provide is for informational purposes only, and you should seek a duly licensed professional for investment advice. So now I'm going to pass it off to fellow co-founder and president, Kerry Krasinski, who will introduce Real Impact Tracker and the certified Real Impact community.
Thanks so much, Gabe, and thanks everyone for joining us. A few very brief words of thanks, if I could, before we get into the meat of the webinar. Thanks first of all to the 5 certified fund managers that have managed to qualify to a very high bar of impact performance, and those being Stewart Investors Sustainable Funds Group and Zevin Asset Management, who we're thrilled to have with all of us today, and we'll hear from them shortly. The other 3 fund managers that we have managed to certify, Walden Asset Management, Terra Alpha, and Stance Capital, and the other institutions that we're liaising with. Through our certification process, we have found that these 5 managers are part of an all too short list of best performers, really too short for what is required of our financial systems. But thanks so much to all of you for the work that you do. It's seriously important, and we look forward to hearing from Stewart and Zevin very shortly. Also, quick thanks most of all to my fellow co-founders, Patrick Reed, Gabe Rissman, to 2 brilliant recent Yale students who graduated, and been thrilled to work with both of them. They're both very strong contributors to the field, and nothing's more important than getting young people in positions of influence. This is one of those steps that we all need to take, is to empower the next generation. Also a thank you to Peiwa Chen, our 4th member now, a Yale freshman. And also to the Center for Business and the Environment at Yale, who's backed us with a grant. We're thrilled to have the backing of Yale for this relatively new endeavor. And also, lastly, a very big thank you for all of you listening in today for the work that each of you do, seeking more impact, which is just so badly needed. And that's actually why we're here today for the first of our webinars and the launch of our certified Real Impact community of fund managers, and we really are quite excited about that. We set out last year at Real Impact Tracker to answer a very simple question, which is how can an investor have more impact alongside financial returns? It's a very simple question, and it's one that more and more people are asking, which is great. And I think there's record interest in the field. I was looking at Google Analytics the other day, and the term impact investing is kind of off the charts of interest compared to all the other terms that we've used to describe the work that we all do. But the terminology really isn't that important. What's most important is about finding fund managers and that actually can have a positive impact on the environmental and social issues of our time. That's just super important. And we did our first round of fund ratings, some of you may know, and if you visit our website, you can see those just freely available for your viewing, kind of at the end of last summer. And the idea was to show the average American investor, which is such an important component of ownership, that in effect, there are fund managers doing excellent work, and maybe some that have more work to do. And perhaps the biggest takeaway of that first round of fund ratings that we did was that investors can actually have more impact without giving up financial returns. A very important finding, we believe, because that totally shatters the myth of underperformance, I think, permanently. But even more importantly, we seem to be in something of a post-policy period, at least for the time being, making the sort of impact that we all need to have within our investment choices even more essential. And now there's no excuse for inaction whatsoever. Not that there ever was one, but now there's literally not only no excuse for inaction, but action is imperative. So it's just fantastic that we're able to shine a light on the field and help investors understand the ramifications of their choices. And one other major takeaway that I want to make sure is shared is that investors can actually have impact on the $75 to $100 trillion of value in both public equity as well as fixed income, and not just the 100 billion or so that's been measured by the GIN within so-called ring-fenced impact investing, and which is great, but complementary to that is the ability to have impact in the largest asset classes of our time, which is something of a 1,000 times larger potential impact if you just do the math on 100 billion versus 100 trillion, if not more when you add fixed income. So there's potential to have much more impact than we have today on the status quo. I think that's a really important thing to not lose track of. We also looked around at the existing fund ratings that exist in the field, the Morningstar Globes. I was particularly excited to see that launched in early 2016 because that's literally how I personally came into the field. This is my third career. For those of you who don't know me, I teach at Yale and at Brown, and have done books and advise in numerous capacities, including now president of Real Impact Tracker. I actually entered this field with this premise of creating fund metrics, worked with TrueCost on that basis in the mid-2000s. So it was really great to see the Morningstar Globes go live, but when you look closely at them, they don't really pick up the sort of work that the field is doing. The incredibly important shareholder engagement work of the likes of our certified fund managers, the public sphere work that needs to be done, think of Larry Fink's letter, and the influence that changes to voting patterns can have, and even the culture and the strategy of fund managers. None of this is picked up by the likes of Morningstar in that Globe system, nor the similar fund ratings of MSCI, nor the Barron's lists you might see where basically you're just taking the holdings and doing a weighted average calculation. And that's, hand up, I thought that would have been interesting, but it just misses out on the sorts of impacts that fund managers can and should have. So it's, that inspired us to kind of go down this path. And so we did start last year with that cross-section of funds that you can see at our website. I'll let Patrick Reed talk a bit later on this webinar about our future plans in that regard. Here's a quick example of some of the interactions we had while we did that work. And we talked to Catherine Collins at Putnam, who's doing fantastic work there. And at the time, Putnam, the fund that we took a look at, had gotten an F, and they didn't disagree with that. And now, lo and behold, in the last week or so, Putnam has launched an over $4 billion sustainability fund. And I can assure you that fund will not get an F. And that's the sort of progress we plan to encourage and to continue to track here at Real Impact Tracker. I think that's the sort of major difference that we're looking to have. So please do visit our website and take a look at the work we've done, including on the certified fund managers that we've been working with, including the two you'll hear from a bit later. So just to clarify the second step we've taken now in this launch of our certified real impact community of fund managers, we wanted to extend our thinking, from fund ratings to evaluating institutions. And we've set a fairly high bar of performance on three areas of work: ESG execution, and what I like to call shareholder engagement intensity, as well as work in the public sphere. So those three areas basically are our criteria, and we're happy to go over that in more detail. There are methodology documents at our website, but we feel our potential is to help shine a light on these practices so that, what is likely something less than 10% of fund managers today who would qualify to our high bar minimum standard, we want to see that become 20% by 2020 or even 50% by a later date once the field continues to evolve. And it's only going to evolve if there's demand, and that demand needs to come from the average investor who increasingly cares about the connections that their investment dollars have, who actually want to have more impact and actually make that impact happen through encouraging their existing managers to do better work or choosing fund managers that are already doing leading work. And our role, we feel, is to help investors understand better the impact choices that they have. And it's really up to individual investors as well as large asset owners in aggregate to take the necessary collective action so that the financial system and society at large basically functions with the right checks and balances that are otherwise arguably somewhat missing. So we hope at Real Impact Tracker to be the ones informing the investment public on who's doing the best work. Again, please visit our website. You can peruse the pages of our certified community, and you can take a look across the board at the work we're doing. I'm very proud to be working with, again, Gabe and Patrick on this. But it's very important to stress that in order to be part of this community as a fund manager, you really do need to perform to a very high standard. And for that reason, we're particularly proud to be here today with two managers that we have found to be doing just that sort of excellent and thoughtful work. They both score very highly in the criteria that we've set out, and they have been certified by us at Real Impact Tracker. And they're among our first cohort of 5 fund managers, as I've mentioned, who've achieved to this high bar standard and then some. Boston-based Zevin, a long-standing expert in the field, a leading shareholder advocate, as well as international specialist Stewart Investors based in Edinburgh, but operating globally within their sustainable funds group. I think actually Stewart Investors might be the largest sustainable investor in the world, managing $30 billion, if I'm not mistaken. We'll let Rob from Stewart tell us whether I'm right about that. So that's kind of great to have a particularly large investor as part of our first cohort and an international one. So we really appreciate that. But first, we're going to turn this over to Boston-based Zevin. But we really look forward to hearing from both Zevin and Stewart and into the work they do, and to show you the variety of fund managers that we've started certifying. And the most important thing for us is to see more assets flowing into this sort of work. So it's fantastic to have 2 of the leading fund managers with us today. After we hear from Zevin and Stewart, we'll go into Q&A, and then we'll hear a bit more about the future plans that we have at Real Impact Tracker. So with that, let me turn this webinar over to Pat Tomeno of Zevin Asset Management. For those listening in, while Pat gives us some of the work that they're doing, please feel free to peruse the Real Impact Tracker community pages on our fund managers. You'll see a lot of specific detail, videos even, and examples of the work that our certified fund managers are doing. And so while Pat gives us a first overview of the important work they do at Zevin, Pat, let me thank you for the work you specifically do in this regard. It's been a real pleasure to get to know you through this process. So with that, let me turn this over to you. Pat, thanks so much for joining us.
Thank you. Thanks, Kerry. Thank you, Gabe. I'm Pat Miguel Tomeno. I'm the Director of Socially Responsible Investing at Zevin Asset Management in Boston. Zevin is a equity asset manager in Boston with about $600 million under management for individual clients and families, as well as institutions, nonprofits, and foundations. So that's a bit about who we are and who our clients are. And our clients really understand impact and speak to us all the time about the imperative and about their curiosity about the impact that they are having in terms of environmental, social, and governance factors in their investments. And there's really two motivations behind that. It maps onto the different kinds of clients we have. We think that institutional clients are getting there and understanding that ESG, environmental, social, governance analysis, integration, and advocacy is becoming part of good business. I don't have to remind probably most of the folks on this call about the statement from Larry Fink last week. Basically, further establishing ESG analysis and impact rightly within the mainstream of portfolio risk management and mainstream of investing. So we're seeing uptake and interest from our institutional clients on that. And then individual investors, the folks who are form many of our clients and their families. And speaking as an old millennial, I call myself generationally. Many of my peers, folks who are now entering the part of the life cycle where they're looking at their savings and trying to figure out how to look after their futures and look after their children's futures, but also do so in a way that does not sell out the future of this planet and its people. So I'm having conversations, with our clients, but also just people in my social circles who are asking a lot of the questions that Kerry and his team have set out to answer for folks. I call this the iPhone problem, kind of as a shorthand and not to single out Apple. But the iPhone problem goes like this. We all have in our back pockets a device, a piece of metal that, again, as an old millennial, someone who remembers the shrill beeps of a dial-up modem, I could not have imagined even 20 years ago what this thing does. But if you look at the news and you read advocate reports, there is no escaping the fact that the gains and the technological achievements and that iPhone in your back pocket entails a lot of concerns about human suffering, about empowerment, about oppression, about resource use and stewardship of our environmental resources into the future. And folks come to us, I think, for the same reason they'll log on to Real Impact Tracker and look at the certified community. Folks come to Zevin Asset Management because they're looking to reconcile and put into context a lot of the tension that they have around the way capitalism works, the way we've allowed capitalism to work in the absence of ESG management and impact management. So that's a very, very powerful tension. It's one that more and more generationally, more and more young people are going to want to resolve through their investments. Zevin Asset Management has a great proposition to help folks understand, put in a context of that tension, and not simply basically screen it away or alleviate folks' concerns as a matter of sort of as a religious exercise, but to turn around and say, yes, you're concerned about the way this economy works and the externalities and the impacts that capital markets enable. You don't just have to be worried about that. You can, in addition to screening your investments and to avoiding investments that don't accord with your values, you can turn around and create positive impact by using your shareholder rights and by finding an investment manager that will create positive impact for you. So that's what we're hearing from clients. That's who we are, and then that's who our clients are. What we do, briefly in the next 5 minutes, I want to, basically run you through the way we work at Zevin and the way in which we feel that, has been captured really dynamically in a very user-friendly way by Kerry and his team on the Real Impact Tracker. Zevin Asset Management has a long legacy in socially responsible investing. We've been doing this for 2 decades and change. Our founder, Robert Zevin, was he's a PhD economist and someone who laid a lot of the intellectual foundation for the what was essentially the first big impact investing struggle in modern sustainable investing. The effort to disentangle companies and their risk profiles from a sinking ship, the racist and authoritarian apartheid regime in South Africa in the 70s, 80s, and 90s. So we were there at the beginning of that. Our founder, Robert Zevin, was. And like many of the socially responsible investing SRI firms we get called out there in the market, that's the way the consultants know us. We took that principle of screening out high ESG risk companies, screening out companies that don't accord with our clients' risk tolerance and also values. And we helped to broaden that to the point where we are today, where we help clients institute a variety of screens based on environmental performance, based on the way companies treat stakeholders, customers, communities, employees, based on a concern for human rights. And then also we are, engaged in helping a lot of many of our clients implement fossil-free portfolios. On the flip side of that coin, we use our considerable expertise in researching companies on ESG factors to find companies that contribute positively on ESG and have substantial ESG opportunities, not just ESG risks. So we're engaged finding companies that we find attractive from a fundamental perspective, but then are also poised to take part in big secular sustainability positive trends, and also companies that are solutions providers on renewable energy, sustainable transport, climate solutions, access to finance, global health, et cetera, et cetera, et cetera. So, we feel that's picked up and really front and centered for folks on the Real Impact Tracker website. What we're especially known for out in the marketplace is the other side of the coin. There's the analysis, the ESG analysis that you do on the front end. Once we own a security, we are 100% committed to active ownership and creating impact through shareholder advocacy. So to give you some recent numbers on that, we worked in 2017 on 90 social and environmental engagements with our companies in our portfolios. That includes 21 shareholder proposals, many more filed than 21, but 21 of our shareholder proposals went to votes at company shareholder meetings. And those actions are focused on material risks facing companies in our portfolio, issues where we need to see companies make a targeted change in order to address a situation where value is at risk. And we're generally working in sort of bucket areas of economic justice, civil rights, and climate change. And to give you an example, this work contributes to real impact in the form of wins and in the form of substantive dialogues that are going to create wins in the future. So, for example, our proposal on climate strategy at PepsiCo in 2016 into 2017 spurred that company, PepsiCo, to adopt a science-based greenhouse gas target, one that's based on Paris, and to endorse the renewable energy buyers principle, something a big initiative that's going to help bring more renewable energy online for corporate customers. We are pioneering proposals that not only address gender gaps in compensation, but also gaps between workers of different races and ethnicities. And we're really leading the charge to do that in retail at companies like Marriott and companies like TJX that rely on the labor of Black and brown women, but then are not necessarily very equipped to manage risks that marginalized folks in their workforces face. So we are working with companies on that. We had a great win in this fall on a new campaign that we're very excited about relative to paid family leave. Paid family leave is a very important issue from two perspectives. You hear a lot of investors talking about gender lens investing and analyzing companies and getting companies to improve in the way that they treat women in the workforce, but also women customers. gender lens investing is also just really solid human capital management. You want to make sure that you retain the most talented people in your workforces, that you nourish those people, and that the people who do well within a workforce are identified and promoted and are able to stay in the workforce. So paid family leave allows very talented women, but very talented parents in general, to stay in the workforce and not to drop out or not to form a part of the attrition profile of a company. So we actually benchmarked a bunch of companies, prominent U.S. companies, on their approach to paid family leave. Last summer, we wrote to just over a dozen of them, and we pioneered the first shareholder proposals on that issue, which spurred Starbucks to really substantially change its policy and close gaps between birth moms and also adoptive parents and dads in their workforce. We're working further with that company to close the gap between the benefits that are provided in the headquarters and the benefits that baristas get alongside. So that's a great win, that and one that really parlayed into another win at Walmart on the same issue you might have seen publicized last week. The last thing I'll highlight, just in the way of wins and the real impact we're bringing home on behalf of our investors, both institutional and individuals. This is an example of an engagement that's really hard-hitting and is poised for even more success. Many of our clients hold, on a legacy basis, stocks that they've inherited, perhaps positions in oil and gas companies, some of the biggest players with the largest carbon footprints that you can imagine. So on behalf of a couple of investors who hold shares in Chevron, we have been Zevin Asset Management has been the lead proponent of a proposal asking Chevron to adopt an independent chairman policy. The rationale behind that being that in the global oil and gas sector, where you have risks that are playing out well in the short term already on the climate change front, but where you have a risk like climate risk that's going to play out over 40 years, and decisions need to be taken now that you can really only see playing out in their entirety on the horizon. You need to do all you can from a corporate governance perspective to ensure that the company is seeing, internalizing, and managing those risks. So you need an independent chairman from our perspective, and you need to start implementing a lot of the innovations in terms of corporate governance that we see in the European context that would be very helpful for a global oil and gas company. So last year on that proposal at Chevron, on behalf of our investors, we secured a 40% vote at that annual meeting. That was, for common sense corporate governance reform, but it's one that has a bearing on climate risk, like I said, also litigation risk around the world, and political risk where Chevron faces it. This is, not to overstate things or to get too far over my skis, but we're in a period of time with the global oil and gas sector where investor concerns on ESG issues and efforts to get impact on ESG are going to be more and more successful. You saw majority votes on climate resolutions, shareholder proposals at Occidental Petroleum and at Exxon last year. And so, this is an issue, the independent chair based on climate risk at Chevron, whose time has come, and we're going to make sure that the company knows that, as well as our peers, investors who are also beginning to look for impact in furtherance of their social and environmental values, but also to manage portfolio risk. So that's a snapshot of the way we approach impact. It has a lot to do with shareholder advocacy, both in the service of long-term risk management, but also making sure that alongside doing well with our portfolios, we're trying to do good to the extent we can within the overall parameters of sound investment management. So I'm happy to take calls later, and really looking forward to what our colleagues at Stewart are up to.
Great. Thanks for that, Pat. Much appreciated. The work of Zevin is very important, and it's fantastic to have you give us a few words on that work. So now we'd like to turn it over to Rob from Stewart Investors. A fascinating institution. I think you'll see doing things slightly differently from Zevin. Rob, over to you. And I assume you're in the wonderful city of Edinburgh. Hello, Rob, are you still with us? Yep.
Hi, apologies for that. Can you hear me okay?
Yeah, we hear you great. Are you in Edinburgh today?
Yes, I am. And thanks very much for that introduction, and also for inviting us to take part in this webinar and to be part of the Real Impact Initiative. I'm one of 12 investors in the Sustainable Funds Group, which I should clarify is one of 2 investment groups at Stewart Investors. So, Kerry, your claim that we're the biggest sustainable fund manager in the world was very generous, but more accurately, we manage in the region of about $18 billion for clients across a mix of pooled funds and also single client mandates. So together with the other group in Stewart Investors, that's where the total of 30 billion comes in. In the US, where I imagine most of you who've tuned in are based, we have a couple of pooled funds and one dedicated client mandate. We're still at the very early stages of forming client relationships in the US, but we do feel very fortunate to have got the early support of some great foundations, family offices, and asset managers who we respect and with whom we feel we share a good understanding of what it means to invest for sustainable impact. We started our sustainable investment journey back in 1995 in the Asia Pacific region, oddly enough, under the leadership of David Gate. And we went from there into the Indian subcontinent, emerging markets in the widest sense, and then onto our worldwide strategy, which is now just over 5 years old. So hopefully that experience has given us a good grasp of some of the challenges, sustainable development challenges in both developed and developing markets. We really only know one way of investing, so all our funds and mandates adhere to the same investment philosophy, and we maintain the same focus on long-term sustainable development as a key driver of investment performance. I also need to say we're active, long-only, long-term, bottom-up investors who invest with an absolute return mindset. I'm sorry, that's a bit of a mouthful, but 2 key things. When I say long-term, I mean we like to invest in companies feeling confident that we can hold them for 10 years or longer if possible. This is good for compounding, and we're big believers in the power of compounding, but it's also it's essential for sustainability investing, which in our view is by definition a long-term process that requires a lot of patience and persistence. By bottom-up and absolute return focused, I mean we take the time to understand companies from the ground up, and we build our portfolios in the same way without adherence to benchmarks or any top-down sector, country, or regional allocation weightings. Nor do we aim to emulate the performance of any benchmark, especially if it's a declining benchmark. We define risk as the risk of absolute loss and gains as absolute, not relative gains. Enough of the sort of background. In the time I have, I thought I'd touch briefly on 3 questions. The first is, what do we mean by sustainable investment? Second, what kinds of companies do we invest in? And third, how do we invest and engage with companies? So on to the first of those, what do we mean by sustainable investment? It's perhaps helpful to start by saying what it doesn't mean for us. It doesn't mean socially responsible or SRI investment, nor does it mean ethical investment with a capital E, nor does it mean green, clean tech, thematic sustainability, best in sector or best in theme investing. And I think we're still trying to work out whether we're impact with a capital I investors. But as Kerry said, these things are matters of terminology. Key thing to say is we don't negatively screen companies or exclude them from consideration, nor do we positively screen companies to find popular sustainability darlings that have to make it into our portfolios. Now, there are many ways to the top of the mountain, but for us, screening is a shortcut, and it undermines the need, we feel, to think dynamically about the real sustainability positioning of companies. So we avoid screening. The reason we don't invest in the so-called sin sector companies like tobacco companies or oil and gas producers or sugar pushers like Coca-Cola is because These companies face sustainability headwinds from regulation and sugar taxes and changing consumer preferences. We invest instead in companies like Vitasoy, the Hong Kong-based producer of healthy food and plant-based beverages, because we think it can contribute to healthier diets. We invest in companies which we think have sustainability tailwinds. And for us, that means high-quality companies that are well-positioned to meet the challenges of sustainable development. We define sustainable development using the original definition put forward by the Brundtland Commission in its 1987 report to the UN, which is the kind of development that meets the needs of the present without compromising the ability of future generations to meet their own needs. It's a simple definition that recognizes present development needs and the idea of intergenerational responsibility. It also captures the powerful idea that we need to use natural and financial resources wisely for long-term economic and social development and for improving the personal well-being of people everywhere. The idea isn't complicated, we don't think, but turning it into reality obviously isn't easy either. As investors, though, we think we have a very powerful tool at our disposal, which Kerry mentioned earlier, which is that we can choose where we invest our money. And our investment belief, the sort of golden thread, if you like, that runs through everything we think and do, is that by investing in companies that meet sustainable development challenges, we can play a positive role and generate the best possible risk-adjusted returns that we can for our clients. On to the second question, what kinds of companies do we invest in? Over time, we've found that there are 4 behavioral traits or hallmarks, if you like, of good sustainability companies. The first has to do with resource scarcity. Good sustainability companies show an awareness that financial and natural resources are scarce and that there's a commercial, social, and environmental imperative to use them wisely. And many of the best sustainability companies do one very simple thing, which is they help us do more with less. The second attribute has to do with time horizon. The leaders of good sustainability companies favor the long term over the short term when making commercial decisions. The third is an idea of inclusiveness. Good sustainability companies are led by responsible stewards who recognize the commercial usefulness of looking after the interests of all stakeholders and not just shareholders or themselves. In other words, they strive to earn and maintain a social license to operate. And the fourth attribute is relevance or adaptability. The best sustainability companies are flexible and they're adaptive. They recognize that their commercial offerings and business models and operations have to evolve to reflect a rapidly changing world. So we find these companies not by filtering down the universe of 45,000 odd publicly listed companies or using negative screens and parameterized models, but by meeting companies and following management leaders and looking at the competitors of our very favorite companies, and by reading a lot and doing a lot of our own research and also commissioning research from others who know more about particular fields than we do. And to focus our search on potentially interesting sustainability companies, we look at the universe of companies through 3 lenses. The first is sustainable goods and services, the second is responsible finance, and the third is required infrastructure. And it's experience, really, and trial and error that's led us to settle on those 3 lenses. They give us a way to think about and understand the companies that we like and that make it onto our quality list and into the portfolios we manage. Very briefly, sustainable goods and services companies make things and do things that we all need. They have a positive impact on human health, welfare, and environmental efficiency. They include consumer companies that make healthy food and drinks, laundry, home and personal care products like Unilever, the giant Anglo-Dutch company, but also companies like Vitasoy, which I mentioned a moment ago, and Marico, the Indian manufacturer of coconut-based skin and hair care products and edible oils and healthy foods. And they include healthcare companies like Cerner, the US healthcare data management company that's helping improve efficiencies and take costs out of the healthcare system. Responsible finance companies help people and enterprises save, borrow, invest, and insure against risks. They contribute to economic and social development. In our world, they include conservative banks and financial services companies, as well as responsible insurers. So companies like Jack Henry, which provides IT processing and automation software and hardware to 11,000 US credit unions and community and regional banks. Housing Development Finance Corporation in India, the mortgage finance group built on the issuance of small and medium-sized home loans. And Navigators Group, a disciplined underwriter of marine, environmental, energy, and P&C insurance. Required infrastructure companies provide the basic building blocks and service infrastructure that societies need to develop and thrive. They contribute to better environmental outcomes, resource and operational efficiency, and also safety and logistics. So they include some industrials and materials companies, logistics companies, utilities, and design, testing, and safety companies. So companies like ANSYS, the engineering, simulation, and optimization software company that's enabling the shift from quite expensive hardware to much more efficient software-driven design and safety testing. Automra Systems, the Norwegian-based maker of reverse vending, recycling, and sensor-based sorting equipment. And so on to our third question, which is how do we invest and engage with companies? I'm going to describe our approach in 2 sentences and then expand briefly on each of these. So here are the 2 sentences. We build portfolios of our favorite 40 to 60 high-quality companies, which in our judgment are well-placed to contribute to and benefit from sustainable development. The second sentence is we integrate environmental, social, and governance (ESG) considerations throughout our investment process, and company engagement is an integral part of that process. So taking those in turn, the first one, the key ideas of quality and sustainable development. Quality for us is about quality of people, franchise, and financials. And the main quality attributes we look for in companies are capable, trustworthy stewards who operate with integrity, long-term time horizons, risk awareness, and a commitment to looking after all stakeholders. Competitive, resilient franchises that grow and generate cash consistently and sustainably by providing products or services that we all need. And then soundly managed finances, conservatively managed, preferably net cash balance sheets, reasonable remuneration practices, an absence of financial engineering and aggressive accounting or corner cutting, as well as complex measures to avoid paying too much tax. And there are many high-quality companies that are not necessarily good sustainability companies, just as there are many companies capable of making a clear contribution to sustainability, but that aren't high-quality investments. We look for both high-quality companies and good sustainability companies. And we find that analyzing the sustainable development performance and positioning of companies is a very helpful way for us to understand the less tangible elements of quality and also some of the less obvious risks that companies face. So in many ways, quality is largely about the attributes of a company, and sustainability is about the attitudes and behaviors of the stewards of that company. The second statement was about integrating ESG considerations throughout the process. Every one of the 12 analysts in our group is responsible for ESG analysts and for engagement with companies. We don't outsource these things, nor do we hide them off to an internal group of experts. Each of us is a generalist rather than a specialist, and we like it this way because we think it helps us apply common sense rather than falling back on common practice. It's a core part of all our jobs to investigate and integrate ESG and sustainable development considerations at every stage of our investment process. And this comes back to our belief that long-term sustainable development is a key driver of investment performance. And ultimately, our responsibility is to deliver the best possible investment performance that we can to clients. We make very limited use of traditional ESG research providers. Most of them produce quantitative, comparative, or sector-based ESG analysis. They gather and crunch publicly available data, but the data-driven methods that they use seem to limit the scope of their ESG analysis in our view. And also, they're not really amenable to providing the sort of bottom-up company-specific analysis that we value. So we investigate and make judgments about ESG considerations mainly by analyzing publicly available information on companies ourselves, commissioning research by specialists who might have deeper knowledge of sustainability questions than we do, and by meeting companies and understanding their attitude and commitment to addressing sustainability risks and challenges. The last thing I want to say is just about engagement. It's obviously an integral part of our role as investment analysts. We engage by building relationships and hopefully rapport with company management, in a sense, by earning their respect and right to engage. We try to be collaborative and not confrontational, and we found engagement works best when it's based on trust, long-term relationships, and a nice, frank, open dialogue with companies. And really, we consider every interaction with a company to be an engagement, and we always engage with our investment case in mind so that the engagement remains direct and meaningful and doesn't become disconnected or reduced to a sort of box-ticking exercise. Examples of the things that we've been engaging companies on over the years include nutrition and sugar content of food and beverages, health concerns around ingredients such as triclosan used in toothpaste and detergents, social values being communicated in the marketing of products like skin whitening creams, plastics packaging, microplastics, microbeads, and nanoparticles in products. We've engaged on bank lending practices and sustainable development risks, treatment of workers and supply chains, diversity, sexual harassment and workplace practices, board compositions, remuneration practices, companies not paying enough tax, accounting practices, and debt and balance sheet robustness. Over the years, we've also done a certain amount of what you could call thematic engagement. So, for example, we've for several years now been engaging the consumer companies we hold for clients about their approach to addressing environmental and social challenges related to their palm oil supply chains. And we're also working with the Access to Medicine Foundation on the idea of creating a new access to essential and generic medicines index, which would help shed light on the work that pharma companies are doing to help promote greater awareness and access to healthcare. I'm not going to speak about broader industry engagement. Perhaps we can talk about that in the Q&A, but just to hand it over to the question part of the thing.
Oh, great. Thank you, both Pat and Rob. Really fascinating to hear the different approaches, and I think we can all see that these are two very thoughtful firms doing interesting work. There have been a lot of questions. There's been a lot of interest in this webinar. We really appreciate that. A lot of different questions. If we don't get to your questions in the remaining 10 minutes, please, we're more than happy to talk to you offline. But with this, I'm going to turn it over to Gabe Rissman, my partner, and he's been collating some of the questions that came in both before this webinar and also during the webinar. So, Gabe, over to you.
Thanks, Kerry. Yes, so I have collected some questions, and I'm hoping that we'll be able to ask two questions. The first is if you could talk more in particular about what your future impact plans are for the upcoming year and what you're hoping to do more of.
Maybe we should go in the same order as presenters. So maybe Pat and then Rob with a brief answer to each question.
Sure. In shareholder engagement, you know, a lot of what we do is obviously dictated by what our portfolio looks like. And I think the process that I explained on the ESG research side results in a portfolio where we have a positive thesis about how companies in our portfolio will ride a wave of sustainable development and will be positive solutions providers, but none of these companies are perfect. So we, in the course of our ESG research, as we're researching a stock, identify a few really important environmental, social, and governance issues, risks, and opportunities for active engagement. So it's all holding specific in that way. Our portfolio at the moment is involved in the tech sector, and so we have a core of tech sector holdings, you know, in the portfolio. So we're focused on ways in which we can be very impactful with tech companies around key environmental, social, and governance risks. And one thing that's mission critical in tech sector that, from our perspective, is diversity and inclusion. This is an area where, you know, diversity based on gender and also race and ethnicity is something that many folks within the tech and the internet sectors will admit that there is a mission critical problem within the big listed tech companies. And you know, at one level, they're very, you know, we talk to managers who are very interested in bringing in training and bringing in recruitment and incentives to improve the pipeline and diversify their pipeline for diverse engineering talent. But then they have two challenges on the back end of that. It's, you know, once you have hired folks from historically underrepresented groups, it's a challenge to do the specific things that you need to make inclusion happen, which is to make those people feel supported, to work them through with a cohort who will be promoted and developed at the right time, so that, you know, you can invest in workers and really develop the most talented people you can. And there are, you know, really compelling business reasons for doing this, which I don't have to re-rehearse in detail. But McKinsey has done some amazing research recently on the quality of leadership teams which have gender and racial diversity, and the profile of companies that actually financially outperform when they are in the leading quartile for gender and racial diversity. So what we're doing over the course of actually this shareholder meeting season is we've filed several shareholder proposals asking companies like Alphabet, Citrix, eBay. We have an ongoing conversation with Apple to take the next step, and at the same time that they are trying to build the pipeline, really, from a governance perspective, manage diversity and inclusion as if it were a mission critical issue. So, you know, just like we would ask an oil and gas company, or, you know, has become de rigueur in oil and gas or in mining, a CEO to tie a portion of executive compensation to delivering against that mission critical ESG area. We're asking CEOs in the tech sector to find a portion of executive compensation to tie with reasonable diversity and inclusion goals, or an indication of improvement within those companies on that issue, so that investors can have a line of sight into the approach and how things are moving forward, and that's so that we can drive impact through what we know as investors is a very powerful lever, the compensation plan. It's as simple as putting money where their mouths is, and it's an area where we're having a lot of potential for shareholder engagement in the next year, so stay tuned.
Thanks, Pat. Rob, do you have an answer for that one?
Yes, for us, I mean, I think one of the things we've realized is that our engagement needs to be more focused. So we realize that there's certain engagement issues which are always going to be self-presenting and also to some extent ad hoc. But what we'd really like to try and do over the coming years, and I'm not just talking next year, but, you know, for the next 3, 4, 5 years, is focus on 3 engagement priorities. The first is executive remuneration, because we think it speaks volumes about alignment, about responsible risk-taking, about accountability, but it also touches on much wider issues relating to equality or inequality in society. The second issue is diversity, and we're going to start in the obvious place, which is gender diversity. And the third is an environmental concern, which is pollutants in supply chains and in waste discharge and downstream product use. So we really want to try and focus on those three themes over a period of time, shake them down, seeing them across a range of the companies that we invest in, and see what progress we make with those.
Great, thanks for that. We only have another 4 minutes. We could have gone on for quite a while on this webinar. We will be doing another webinar soon for those interested. But Gabe, do you want to ask that second question? Maybe each participant take only 1 minute, and then we'll have a wrap-up comment from our partner, Pat.
Great. Yes, so the next question is, if you could, the 1 minute answer on how country differences in transparency and accountability weigh into your investment screens.
Sure, that's something we're always grappling with as global investors. And I actually, not to be too craven, but I would end my whole intervention today on a pitch for impact investing and ESG investors who have had to make it our business to be very engaged with management in companies all around the world, because we're trying to get material extra financial information all the time from companies. And so whether that's a company within the US context, which has a very well-developed investor relations function and folks to talk to me about my concerns about water use or diversity inclusion, I'm having to reach into the company and really extract high quality information that's going to, provide ESG insight. So that practice is something that we've always done with respect to, say, maybe an emerging markets context where transparency and accountability information is not as developed, or the expectations are slightly different, having come up differently. So in engaging with, I heard actually Rob mentioned HDFC, and having engaged recently with HDFC Bank in India, where there is solid reporting on the financial side and less solid reporting on the ESG side. My standard practice is to jump on the phone and have these conversations with the folks who are poised to speak on them in an informed way, and find that information no matter what. And I know that my colleagues across the impact investing space, the kinds of actors that are being rated on a Real Impact Tracker, we all employ that practice, and it's something I think that will be a difference maker in the marketplace going ahead, hopefully.
Very briefly from me, it's much the same. It's not relying on publicly available information, which is obviously much more scant in a lot of developing country contexts, but building relationships with management, trying to pull at threads in conversations with them all the time, and trying always to scratch and dig a little bit deeper to try and understand the context that companies are operating in, the particular obstacles and challenges that they're facing, and the contextual difficulties that they're dealing with. And also understanding management's commitment to improving sustainability outcomes. So we're trying to look for a direction of travel and a commitment from management on the part of companies. And that's the best way for us to get information.
Now, thanks so much, both Pat and Rob. I hope everyone can see the importance of the insights that thoughtful fund managers can bring to the table. And if only more funds under management were in the hands of people so thoughtful. And with that in mind, if I could just turn over the last part of this webinar to my colleague Patrick Reed to give a little insight into the future plans of Real Impact Tracker. Patrick.
Yes. Hello. Thank you, everyone. And I'm going to keep this short since we're out of time, but just take a couple minutes to describe our future plans and how they tie into our core mission. So as Carrie stated at the beginning of this webinar, our core mission and what we're trying to accomplish is to grow the movement so that everyone can participate in impact investing and having impact with investments. And in talking with friends and family and looking at surveys of the field now, we know that more people than ever before want to do this, and yet there are some barriers, which we think of in two key categories, one being information and the other being access. Today, as we launch our certified community, we have been talking about how we can shed light on fund managers having impact, and this is key now because, as also mentioned on the call, at this moment in time, there are more and more new products, new financial products opening that claim to have social and environmental impact. And we see the need for there to be an independent, trusted source to help people sift through all this marketing and really find the information that they're looking for. And we think of this as being very helpful for this industry in the same way you can think of information labeling and ratings being helpful for other industries, such as LEED building standards for sustainable buildings or organic labels for food. Once those labels promulgate, people can now make decisions based on that information that they wouldn't otherwise, and you can see the markets in which those labels enter really balloon. You know, organic labels didn't invent organic food, but it's certainly grown since then. Our goals with our certifications in 2018 are to grow the community and get at least 25 new asset managers certified. I would say 100, but in recognition of the high bar we've set, where we think probably only 7% of assets under management would qualify, 25 seems like a more realistic number. And that's also to speak, you know, words of the managers you heard from today and all the high bars of impact that they achieve. The second piece of this puzzle is access. And what we mean by that is people's ability to use their voice. In talking with friends, family, and again, looking through surveys, we found, especially in this day and age, people feel a bit voiceless within the financial system. But once we start talking to them, they realize that their savings and investments actually construct, you know, the fabric of society, part of that system, and that they can have a say. So we are working with a couple of financial advisors to build a web application tool to make it the easiest possible for anyone to be able to practice shareholder engagement with the funds and companies they own. We want to make shareholder engagement easy for all shareholders. In the next month, we'll be testing this application in collaboration with these test partners, and we look forward to being able to announce publicly more about our new platform to amplify the voice of shareholders in the coming months. For those of you who may be interested in that, feel free to contact us directly after the webinar. So with that, thank you again, everyone, for listening. This webinar will be posted later today to our website as a recording. And if you have more questions about the certification or our approach to measuring impact, as mentioned before, please check out our methodology page, but also don't hesitate to reach out directly. We have some contact emails on our website as well. Thank you, everyone.
Thank you.
Okay, thanks. And with that, we end the webinar today. Thanks, everyone, for joining us.
Just